Joining me now with his playbook is PIMCO's head of emerging markets portfolio management, Pramol Dhawan. Pramol, happy Friday. So in my imagination, these tariff barriers in the U.S. have emerging market economies scrambling to figure out what other countries have maybe got a middle class with consumers who might be willing to do a deal. Is that how it's working? And if so, who are the new bedfellows you expect to see hook up here?
Thanks for having me today. Well, the tariffs are clearly important, but it's much more of a dollar story right now for emerging markets. And what we're seeing is really a reversal of a multi-year, decade-long monotonic rise in the dollar. And that's providing a boon to emerging market economies. Over the past decade or so, what we've really seen is the U.S. spend a lot of money running very large persistent deficits. The rest of the world have been saving, running big surpluses, and those surpluses have been recycled back to the U.S. economy, and that's pushed the dollar up and it's pushed U.S. asset prices up. But really, since Liberation Day, we've started to see a reversal of that trend, and that's really marked by the decline of correlation, or the negative correlation, between U.S. assets and the U.S. dollar. Really, it's a very rare event. It happens in less than 4% of the occurrences. But as the U.S. equities fall and the dollar fell, for an international investor, that's an incredibly painful experience because they lose on both sides of the ledger. So really, for the first time in the best part of a decade, investors are really having to think about diversification, which assets that they own, how many dollars do they own, and emerging markets are coming into the conversation once again, and they come in at a great time where balance sheets are very healthy and it's fundamentally an under-owned asset class.
It sounds like you're convinced that this Sell America trade, as we've been calling it, isn't just a blip, that it's the beginning of a new era?
Yeah, I think it's ultimately a paradigm shift, and these paradigms, they take time to formulate. If you go back to the mid-'80s, the dollar cycle was a 25 to 30% move. In the early 2000s, something similar as well, about a 30% move. We've moved about 5 to 7% so far. This is probably consensus in the fact that people are talking about it, but it's not overly subscribed. And this has been 2 decades of build-up of positions whereby the MSCI world comprises about 70% U.S. corporations now. The whole world is long U.S. assets, in particular U.S. equities. And it's really that need to hedge and really rethink the overall allocation to U.S. equities, which is happening right now. And it's not just equities for emerging market equities, it's how many equities do we want in a world where growth is going to be structurally lower, in this multipolar world that we, as we call it, where we think that it's going to be sort of not just an America first agenda, but a UK first, a Europe first, a Japan first, and so on and so forth. That brings down the headline level of growth. In that environment, you want less equities, you want more debt, you want less dollar assets, you want more international assets. It's about diversification. That's the only free lunch that you get in markets.
You think this is good for Mexico?
I think Mexico is in a good position right now, given that it was, broadly speaking, left off of the punitive end of tariffs. But Mexico is very tied to the U.S. economy, and it's going to be highly dependent on how the U.S.-China situation plays out. If the current level of tariffs stay in place, which is 125% reciprocal and up to 245% on certain goods, then effectively Mexico is not going to be immunized from that. Longer term, sure, there'll be some nearshoring benefits, but the U.S. economy will suffer, as will the Chinese economy, and Mexico will be dragged down by that. But if, as the market is expecting, that these tariffs do come down to some kind of quote-unquote normal level between the U.S. and China, well, I think Mexico is pretty well set to be a low-cost producer, a friendly at the southern border of the U.S., and can be a preferred partner to the U.S. as it seeks to nearshore.
We've been asking this week if maybe the bottom's in for the U.S. equities. Is the bottom in for China?
Well, I think China's response has been very interesting here. They had a chance to do what the market expected them to do, which was to do a large currency depreciation. They chose not to do it. And I think they've been very strategic about how they've operated here. Instead of doing a large currency depreciation, which would have helped their exporters out, what they chose to do is keep the currency relatively stable and chose to do a big fiscal stimulus instead. And remember, China has plenty of room to fiscally stimulate to support its economy. They also did some monetary stimulus, but by and large, it was predominantly fiscal. And that will help to draw a line underneath the economy in China, albeit if this continues the way it is right now, China cannot be immunized from the decline in growth. So it will hurt both parties, and it will hurt both parties pretty equally as well.